Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Thank you for tuning in to another one of these quick market update videos. And today we've got a huge wake-up call that I think is going to save a lot of you a lot of money out there. Everyone is off their chair about this market. Okay, I'm seeing daily in our private Facebook group, Let's Talk Money Together, every day people are posting about how their stocks are surging 10 and 20% a day. Now, the stock market is up 6% in the last month alone and just had its best 3-month period in history. Seriously, it seems everyone is all in on stocks again. Hell, I got 3 stock picks from the cab driver on the way into work this morning. But there are 3 reasons why another stock market crash might not be far off. 3 factors I'm going to reveal in this video that could pull stocks back down. So what I want to do with this video is not only show you why I think the rest of 2020 could be a rough ride for stocks, I'm also going to share how to prepare for whatever happens. I'll also be revealing 3 stocks you can buy that should do well in any market. Now let's be clear here though, this isn't about pulling all your money out of stocks completely, okay? You've still got to make money and nobody ever made money sitting out the market. I also don't think it's likely that we're going to see a new low in the market, okay? We might not test that March stock market low, but that doesn't mean we can't fall 10 or another 15% from here and really put a dent in your portfolio. So the stock market surged when we got that last May jobs report on June 5th. The S&P 500 shot up almost 3% on the day when the report came out saying that the U.S. hadn't lost another 8 million jobs, which was the expected number, but we actually gained 2.5 million jobs as people went back to work. Now, this was a huge surprise, and everyone used it as that reasoning that the market isn't so disconnected from the economy. That employment and the economy was actually pretty good, and that's why stocks were surging since that March 23rd low. But there is very good reason to believe that if the next stock market crash hasn't already started, that jobs report wasn't as great as everyone thought, and the next month's report, which is going to drop on July 2nd, could be the start of that crash in stocks. First of all, the report itself came with a huge disclaimer that the Bureau of Labor Statistics wasn't counting unemployed workers correctly. Now, the BLS noted this as a major error in counting temporarily unemployed workers that if corrected, would have actually meant that the unemployment rate was 17% instead of just 13.3% as reported. But beyond that error, there are also a few other factors that I'm watching for unemployment going forward. Understand that most of the bounce, that 2.5 million jobs created last month, were from recipients of the PPP program, that Paycheck Partner Program with small businesses. Now, those checks went out in late April and May for businesses to cover their employee paychecks, so they had to rush to bring back those workers to meet the requirements on the program. And we're not going to get that same boost in June, so don't expect next month's employment numbers to be another surprise upside. In fact, a lot of employers are actually reporting that they can't get their employees to come back to work. I want you to look here at a graphic from the blog 538. This shows the percentage of earnings replaced by unemployment benefits and then also that additional $600 a month people are getting through the CARES Act. Notice a lot of these are over 100%, meaning unemployed workers in food service, janitorial, medical assistants. Millions of workers out there are making more money by staying on unemployment. And economists at the University of Chicago found that 68% of the unemployed workers who are eligible for those extended benefits are making more than their lost earnings. So those additional benefits don't run out until July 31st. So one, you're going to have a lot of people that don't want to go back to work. But a lot of these people probably aren't going to have a job to go back to anyway. Retailer researcher Coresight is estimating up to 25,000 retail store closures this year. That's more than double the 9,300 stores closed last year, which was already an all-time record. 14 major retailers have already filed bankruptcy this year, from JCPenney to Neiman Marcus, and that's not counting the other industries like car rentals and travel companies. But we already knew retail was in trouble. We know the jobs picture isn't great. This next factor, though, is something that I think is really going to surprise the market. So we found out recently that U.S. companies took advantage of the rebound in stocks to sell over $60 billion in shares last month. That's the most ever in a single month. In fact, U.S. stock issuance just through May is higher than every year since 2015. So as investors were scooping up those shares, it seems companies were selling out of their own stock. And not only that, it's been no secret that the stock buybacks have been a big part of the bull market over the last few years. U.S. companies spent over $2 trillion to buy back their own shares over the last 3 years, becoming the single largest source of demand for stocks. You see, for years, companies have struggled with weak sales numbers. Okay, as the economy just kind of grinds along at a 2% pace, those sales numbers aren't great. And if sales are only growing by 2 or 3% a year, earnings growth is going to disappoint unless you can find some way to juice those numbers, those earnings per share numbers. And management found that in those share buyback programs because when you take those shares off the market, that means those earnings you report are spread across fewer shares, so for a higher earnings per share number. This makes it look like the company is growing faster than it actually is when it's just those accounting tricks. Well, now the party's over. Buybacks in January and February were already down 46% from last year, and Goldman Sachs estimates share repurchase programs could drop by more than half in 2020. So not only are buybacks not going to be there to boost those earnings per shares on the market, all that new stock issuance might actually depress earnings per share because now you're spreading those earnings across even more shares. Our nation, unemployment is going to get worse. Earnings per share isn't going to be as rosy as investors are hoping, and the recovery isn't going to be V-shaped. Now, I don't think we're going to retest those March lows, but we could easily see stocks fall 10 or 15% from here. And if the broader market falls those double digits, what do you think is going to happen to all those stocks everyone is piling into? Just look at what happened to shares of Macy's on a day when the S&P 500 was down just 0.6%. Macy's shares fell down 7.5%, more than 10 times the market. Or what happened to everyone's new darling American Airlines, down over 10% that day. So I want to give you 3 strategies you can use and 3 stocks to buy to make money even in a stock market crash. If stocks do drop again, how do you invest and be ready for it? First, I want you to reassess your stocks for which ones are long-term investments. Now, the last 3 months have been an amazing ride, but I know a lot of investors are sitting in stocks they really don't believe in. You might have a good money in those shares of American Airlines or Macy's, but are they really on your long-term hold list? Nation, at this point, if something isn't on your long-term investment list, I say take those profits and feel blessed that you were able to make those double-digit returns so fast because that's just not how the stock market usually works. It's time to get your portfolio back to that group of stocks and funds that you can sit back and hold for the long term. Quality companies with great fundamentals that are going to make you money over the next 10 or 20 years, not the next 10 or 20 days. Now, I know a lot of you are going to be worried about those taxes here, selling some of those short-term winners and adding to your income through those short-term capital gains tax. But you can also look at your portfolio to see if you have any stocks with a loss on them. So if you sell those stocks at a loss, it's going to offset the gain that you made on those other stocks so you won't get hit by those taxes. Next, I want you to revisit your financial goals. Okay, how much do you need in retirement? How much can you invest monthly? And what kind of a return do you need? Because reaching those goals is the reason you're investing. So many investors are just chasing stocks right now, completely ignoring whether a stock fits with their portfolio or their goals. Nation, stocks don't go up 20 or 30% a day like some of these have been doing. Keep chasing them though, and you're going to see very quickly what the other side of that risk looks like. Now, looking back on your goals, I think a lot of you are going to see that you don't need nearly as much risk in your portfolio. Okay, you can create a solid portfolio of stocks without the risk, still beat your goals, and without all the stress of that market timing. In fact, I'm offering a free webinar on exactly this kind of a goals-based investing strategy. It's the same strategy I used to use when working with private wealth clients. It's totally free, so I'll leave a link in the video description below to sign up for that. Next here, to prepare for the rest of 2020, buy some stocks that can act as a counterweight to that stock market crash. Here I'm talking about investing in stocks that can do well even if the rest of the market tumbles. Okay, I'll reveal 3 stocks next, but I'm not just talking about buying safety sectors like utilities or consumer staples, but stocks in other sectors that can still do well in a disappointing economy. Our first example here is Dollar General, ticker DG, and this is the 6th best performing stock in the consumer discretionary sector, up 19% this year. Now, Dollar General sells a great mix of those staple goods, the things that people need and have to buy all the time, but also those discretionary items with the higher margins. Being in that discount category is definitely a plus here as well. Now, I gotta say, it's a little pricey here at 24 times earnings, so this one could have a little bit of a pullback in the shares, but the underlying fundamentals are really strong. Management blew through the earnings expectations last quarter, in the first quarter, beating estimates by 47% and should do well again when they report the second quarter sales. Next here, CVS Health, ticker CVS, and this one is actually down 8.5% so far this year, but it's got a great position in the healthcare market and one of my top picks for second quarter surprise earnings. CVS has a lock on healthcare delivery and benefits from that same in-store effect, selling higher margin items along with groceries, just like Dollar General. CVS is front and center on that virus testing and could see huge upside from the eventual vaccine administration. So now the company beat expectations for earnings by 17% last quarter, and this is a great value play at just 9.2 times on that PE basis. My third pick here is Wells Fargo, ticker WFC, and while I haven't liked a lot of the financial stocks lately, there are a lot of good reasons to start adding this company, Wells Fargo, to your portfolio. Now, this one isn't exactly a counter-cyclical stock like the others and has been hit hard this year, down a whopping 44%, but I think this could be a great opportunity. Even as interest rates have crept back up a little bit, the mortgage market is still booming. Applications for new loans are up 13% from last year, and refinancing is up like 30% from 2019. And Wells is the clear leader in that U.S. mortgage market, so it's going to be the primary one to benefit with this. Wells Fargo trades for just under 0.85 times book value versus an average of at least 1.2 times book in the past, about the past 10 years. So you're looking at nearly a 40% upside just to where it was usually trading and a 6% dividend while you wait. Click on the video to the right for the 5 best stocks to buy according to analyst estimates, as well as the 5 you have to avoid. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.